The Federal Open Market Committee, or FOMC, is a crucial component of the Federal Reserve System, the central bank of the United States. Meeting 8 times a year, the FOMC is responsible for making key decisions regarding monetary policy that directly impact the country's economy. By setting targets such as the federal funds rate and reserve requirements, the FOMC has the power to influence borrowing costs and the money supply, ultimately affecting economic activity, inflation, and employment. In order to make informed decisions, the FOMC closely monitors economic indicators such as inflation, unemployment, and GDP growth. This economic analysis helps the committee determine the appropriate monetary policy stance to achieve the Fed's dual mandate of price stability and maximum employment. By understanding the current state of the economy, the FOMC can make informed decisions that will benefit the overall health of the nation's economy. Following each meeting, the FOMC releases a statement summarizing their policy decisions and economic outlook. This communication strategy is essential for providing transparency to financial markets and the general public, allowing them to understand the direction the Fed is taking and how it may impact them. By keeping the public informed, the FOMC can help maintain stability and confidence in the economy. Looking ahead, the future course of the FOMC will depend heavily on the state of the U.S. economy, particularly in regards to inflation. If inflation remains high, the FOMC may continue to raise interest rates in order to cool down the economy and bring inflation closer to its target level of around 2%. While this may dampen economic growth, it is necessary to control inflation and prevent it from spiraling out of control. However, if inflation begins to show signs of peaking and the economy weakens significantly, the FOMC may slow down or even pause interest rate hikes. In this scenario, the committee would need to balance controlling inflation with preventing a recession, making decisions that will support economic growth while maintaining stability. In more extreme circumstances, such as the threat of a recession, the FOMC may shift its focus from inflation to supporting economic growth. This could involve lowering interest rates or implementing quantitative easing measures, where the Fed buys bonds to increase the money supply. By taking these actions, the FOMC can help stimulate economic activity and prevent a downturn in the economy. Predicting the FOMC's future actions is a complex task that depends on a variety of factors, including incoming economic data and global events. However, by understanding the role of the FOMC and the current economic context, individuals can gain a better sense of the potential policy directions the committee may take in the future. By staying informed and aware of the FOMC's decisions, individuals can better prepare themselves for the economic changes that may lie ahead.